Today, folks, I feel incredibly privileged to own a piece of real estate in my favorite city in all of the world, the business hub of Canada. Of course, we're talking about Toronto, where the Toronto Stock Exchange meets the New York Stock Exchange on the Eastern time zone here, folks, and where I think values will continue to extend to the upside purely because we can no longer build out. Thanks to Greenbelt laws, we can only build up in this city, and there's only one stock that will give you the greatest exposure to this city, and that, of course, is Riocan. For my Rio clan out there that likes to chat about this in the chat group, they posted earnings today, guys. They increased the dividends. The stock is starting to rally, and I still think it's trading at a fabulous discount for those looking for wonderful, juicy income. So if you're on a path to financial independence, if you damn well one day want to retire early, you like these kind of stocks, hit that subscribe for updates in the future. And if you want to join my chat group, baby, go to kylelivingston.com, link in the description below. But we got to break down Riocan and why I'm so fixated and fascinated by this REIT. Firstly, they are starting to do what China is doing now in Toronto, which is building mega towers in the city where you have office, condos, and malls. You never have to leave your building. In fact, this is one of the largest outdoor malls now in the city that is in the Well, which is this project that is owned by Riocan. And it's one of the worst years to have an outdoor mall because, of course, snow has been unbelievable, like a once in a decade kind of snowstorm. But still, don't let that deter you from owning this kind of mall-oriented REIT, because they own the largest land masses in the city, where a lot of these basically malls are starting to get converted, and a lot of concern about them turning into condo buildings, taking away more green space or more outdoor space. But the value is insurmountable because these are the only real shopping centers people can go to. With a current starting yield of 6%, guys, the stock has never catched an all-time high basically since 2013, yet the underlying value of the company is actually should be trading closer to all-time highs. It's trading at a relative discount, and I don't know why it continues to when you recognize what they own. And we're going to round back to the value in a moment. But firstly, I want you to take a look at the commercial charts. What's going on basically in the city right now? This is the Toronto Real Estate Board talking about activity when it comes to commercial sales, leasing. I don't really care because it's been very volatile in the current market environment with the fluctuation, obviously, of interest rates. But what's more intriguing to me is the commercial retail square footage, where we've seen square footage go up to $47.21. That is the retail square footage. Like, the rental prices here are absolutely insane, whereas industrial has been falling off a cliff. And the reason I think this is happening is because industrial is going up like crazy. Everybody's building industrial buildings all over the place. But when it comes to retail, you're very limited because there's no new malls going up. Right now, coming out of the pandemic, I think we're getting this whiplash to the other end now, where store demand, or for people wanting to operate stores, they're limited to where they can rent or lease. So we can see the average net rent per square foot now for Riocan is at $22.39, up from the $19.80 in the pandemic, where this REIT took an absolute tanking. I bought a crap load of it, and we made a really decent return buying it at basically its bottom basement barrel prices. Now, I'm not as much of an income-oriented investor today. I'm a total return investor, but I recognize that if you want income, if you want sustainability, reliability, knowing that this thing isn't going to go anywhere anytime soon, and the dividends are starting to increase again, I think this is your one-stop shop, because Riocan at a glance, 178 properties, 32 million square foot of aggregate net leasable areas, with most of that being in the greater Toronto area, right? Or Toronto itself. I mean, total 80 assets, 16.5 million square feet, or 57.1% of the entire portfolio just sits in the Toronto and GTA, which is absolutely insane to me, right? And if you take a look at the location areas too, Riocan has the best exposure to basically anything near a rail line, basically anything where people need to go and shop. They've done an incredible job. This comes back to the point when you see Starbucks opening up stores somewhere, you typically want to buy in that area because you know they've done their homework. Like, Riocan just owns the most premier properties in the literal most amount of leasable space or acreage over pretty much any other company out there. And that value of that acreage is insane. Like, have you ever seen like basically gas stations in Toronto selling for tens of millions of dollars because the condo value there is just insane? A little, gas station area. And I think like Riocan actually owns huge mall areas. If you actually take a look here, the funds from operation are starting to increase quite nicely on the back of the recovery of retail, and they're expecting to see a 2025 outlook, an increase of 6% from the prior year. This is the recovery that I think so many investors have been looking for. The funds from operation payout, 60%. It's a company that stopped diluting shareholders years ago, and the dividends are now finally in a place where There's a lot of sustainability here and room for growth, which I think is absolutely incredible. And they also are in strong income areas. And I don't know how you get these statistics, but we're talking about a household income of $148,000. And it's been a 45% increase from 2017 to 2024. So the average people that are, in the Riocan areas are typically, decent income earners, six-figure household income earners with really dense populations, right? Which is great because it tends to drive the demand. With necessity-based retail encore tenants, we talked about this, almost 20% just coming from Loblaws, Sobeys, Metro, Walmart, Costco, Shoppers Drug Mart. These are tenants that will never go anywhere. Essential goods and services, 23.9%. Canadian Tire, PetSmart, Bell, Rogers, banks. I mean, you're not going to do anything wrong. Like, this is incredible. Value retailers, your Dollaramas, your Winners, your HomeSense. Almost all of his portfolio sees hardly any turnover because these are, again, grocery encore, liquor stores, banks, things people need regardless, right? These are not disruptible, in my opinion, purely by like e-commerce. These will always be around. If we take a look at the accelerated capital recycling, these are buildings that they've invested into for basically flipping condos, doing development. This isn't like my favorite part of REITs because of how volatile the entire, construction and condo industry's been, from insane inflationary events, costs skyrocketing, interest rates really causing a lot of concern. Luckily, they've been able to pre-sell a lot of these buildings prior to a lot of this volatility, with one of the most valued pieces of real estate in Toronto being 11 Yorkville. This is one of the most expensive areas of the city, and they've had 100% pre-sold. I imagine a lot of people buying this are investors that are looking to flip it because this is like celebrity area of Toronto. It's a very bougie area, which is insane, right? But luckily, they've pre-sold most of these condos, with the exception of a few here. But I think they'll get through these no problem. But again, I'd like the sustainability of the retail side of it, and it's where my fixation has been. Now, if we take a look at the earnings themselves, we can see the monthly distribution increased 4.3%. This is what investors have been waiting for because they did cut it back during the pandemic, but now we're in this turnaround phase, right? So I think this is like one of those dip buying opportunities, because if we take a look at the net asset value, the company's technically trading at a NAV of $25.16, which basically just means at the current assessed value, assets minus liabilities, if they liquidate all the real estate at current estimated values, the stock should be worth about $25 per unit or whatever share. And if we take a look at Riocan today, it's definitely trading at a much superior discount. And typically, unlike owning physical real estate, REITs can disconnect from their underlying asset values. And when you're talking about a great yield, a NAV value that's starting to go up, again, I think we're trading at a very good level for those looking to get a locked in 6% monthly distribution, which I don't think you can go wrong with, considering the company's done a good job at turning it around. Their funds from operations are starting to increase again, and I think that's on the back of the increased, I think at turnover now when they're leasing, they're going to start seeing an increase per square footage because the demand is starting to go up quite dramatically, which is hyper peculiar and interesting. But yeah, everything on here looks pretty amazing, with a great outlook of an increase of 6%. Payout ratios at 60%, lots of room again to increase. We've talked about occupancy remains strong at a 98%, which is absolutely great. Nothing wrong with a 2% turnover. Otherwise, you can dig through this a lot and get some really good insight, and everything that makes me giddy inside, realizing that management's doing an incredible job. As considering the real estate sector as a whole has been in a slump that it has not been able to pull its way out of, I always feel like when you're buying a piece of real estate, your biggest risk is management, but the overall portfolio, so long as it's well structured with low debt to assets, and it's in good markets, that you're better off buying the REIT over perhaps a real estate ETF perhaps, because every REIT is almost like a diversified ETF, because you're getting exposure to tons and tons of different properties. But it depends on what your fixation is. I do like Canadian apartment properties still. I think it's trading at a discount. I still am skeptical on some of the industrials now, with the pricing dropping dramatically for leasing. But I mean, this is a really dynamic real estate market that has been evolving through a lot of volatility. The pandemic, I think, really threw a wrench in how everything operates here, and we're still kind of trying to get through it. But as interest rates drop, I still continue to remain bullish on a lot of the REITs out there. Even though I don't personally have exposure, I don't think for the right investor you should be shying away from this sector. But I'd love to know what you think about all of this in that comment section below.